Welcome to Breaking News to Trading Moves. We have a lot to get through today.
We certainly do.
We're looking at one of the most anticipated documents that drops every quarter, the 13F filing from Berkshire Hathaway.
It's the quarterly report card, really. This is where the rubber meets the road.
For sure.
And, for anyone new to this, the 13F is a regulatory filing. Any manager with over $100 million in assets has to file it. It shows their U.S. stock holdings.
And when Berkshire files, everyone stops to look.
Everyone.
It's basically a window into the mind of Warren Buffett and his team. Now, usually these filings are, pretty standard. Little trim here, a little buy there.
But this one is different.
This specific disclosure for the period ending December 31st, 2025, it just has some moves that really stand out.
It certainly does. And while Berkshire is famous for that hold forever philosophy, this filing shows a very specific change in appetite.
How so?
We're seeing a distinct preference for subscription models and a move away from, let's say, capital-intensive mega-cap tech.
Okay, let's lay out the roadmap then. We have three main headlines to discuss.
Right.
First, a surprising new stake in a legacy media company. Second, a trim of their absolute largest holding. And third, a real slashing of a major e-commerce giant.
Exactly. And the way to frame this, I think, is by looking at quality signals versus risk signals.
What they're buying versus what they're selling.
Yes. What does what they're buying say about quality, and what does the selling tell us about their view on risk?
All right, let's start with the new entrant. This is the one that had people talking right away. Berkshire Hathaway, ticker BRK.B, bought a stake in the New York Times.
Ticker NYT.
Yeah.
It's a fascinating addition.
The filing shows they picked up, about 5.07 million shares.
That's right. And the value sits at about $351.7 million.
Now, for a company the size of Berkshire, let's be clear, $350 million isn't a massive amount of money.
No, it's a relatively small position in dollar terms for them. But the signal it sends is so much louder than the dollar amount. You have to look at what the New York Times actually represents in 2026.
It's not just a newspaper anymore, is it?
Not at all. I mean, if you think back 10 or 15 years, newspapers were a dying industry. Advertising revenue was just falling off a cliff.
Because of the internet, yeah.
Right. But the New York Times pivoted. They stopped relying just on ads and went all in on the bundle.
The subscription bundle. So the news, the cooking app, the games.
All of it. Wordle, Spelling Bee, The Athletic. They built this moat around their content. And by doing that, they turned a volatile ad business into a stable, recurring revenue business.
That sounds a lot closer to a utility company than a media company when you put it like that.
That's the logic. You pay your electric bill and you pay your Times subscription.
Right.
And Berkshire loves businesses with predictable cash flows and high customer retention. They love products that are sticky.
So once you're playing Wordle every morning or checking a recipe, you're just not going to cancel.
You're much less likely to, even if the economy gets a little tight.
So this purchase really acts as a credibility stamp.
It validates the whole model. It tells the market that the paid content plus digital products strategy is durable. It's not just a phase.
And that validation, it doesn't just help the New York Times.
No, it helps the whole neighborhood.
We saw that reaction in News Corporation, ticker NWSA.
This is what we call the peer play. When a giant like Berkshire blesses a business model, investors immediately look for other companies that look similar.
And News Corp owns the Wall Street Journal, Dow Jones. A lot of subscription-based assets.
Exactly. So the thinking goes, if the market re-rates subscription media because of this news, well, valuations could lift across the whole sector.
A kind of sympathy move?
Precisely. If the New York Times is seen as a quality compounder, then maybe News Corp is undervalued.
Okay, so that covers the media side, but there were some other winners in this filing. Let's talk about the safety and value umbrella. I'm looking at Chubb, ticker CB, and Chevron, CVX.
The classic Berkshire halo. We've seen them add to these before, and this filing just confirms you're still building them up.
Let's break them down. Chubb is insurance.
And insurance is the bedrock of Berkshire. It's all about the float holding onto premiums before you have to pay claims.
And in a world with volatile interest rates, that's valuable.
Incredibly valuable. And Chubb is a best-in-class operator.
And then there's Chevron. Energy.
Energy is a cash flow machine. Unlike a tech company that has to reinvest every dollar, a company like Chevron is just returning cash to shareholders, dividends, buybacks.
So a theme is really emerging here. The New York Times, Chubb, Chevron. None of these are high-growth, speculative bets.
No, they're not. They're durability plays. They're businesses that produce cash right now. It signals a preference for strong balance sheets over, future promises.
And speaking of balance sheets, we should probably mention Berkshire Hathaway itself, BRK.B and BRK.A.
It's always important to remember that. The market sees these portfolio moves, buying value, trimming growth, as a sign of disciplined capital allocation.
Shows they aren't sleeping at the wheel.
Right. There's been so much talk about the CEO transition. A move into a new name like NYT, combined with a discipline to trim winners, it just reinforces confidence in their playbook.
Okay, we've covered the winners, the signals for quality, durability, subscriptions. Now we have to look at the other side.
The sells.
And the headlines here were arguably louder than the buys. Let's talk megacap tech.
This is where the narrative gets really notable.
We saw action on the two biggest names. First, Apple, ticker AAPL. They trimmed the position by about 4%.
Now, we need some context here. A 4% trim is really an adjustment. Apple is still Berkshire's largest equity position by a mile.
It's still huge.
It's still sitting at approximately $62 billion.
So they are not abandoning the iPhone maker.
Not at all. This just looks like portfolio maintenance. When a stock runs up that much, it's just prudent risk management to take a little off the table. You rebalance.
Okay, but the story is completely different when we look at Amazon, ticker AMZN.
That is the divergence. They sold about 77% of the stake.
77%. That's not a trim, that's a slash.
It's a near total exit. And you have to ask yourself why. Why keep Apple but just dump Amazon?
That is the big question. What's the difference?
It probably comes down to capital intensity, the nature of the profits. Amazon is a fantastic business, but it is locked in a very expensive war.
The cloud computing wars, logistics, AI infrastructure.
The spending on data centers and chips. Exactly. To stay ahead in AI and cloud, Amazon has to spend tens of billions a year in CapEx. That eats into free cash flow.
Whereas Apple
Apple is a consumer brand. Their capital intensity is much, much lower relative to their cash flow. They sell the phone, they sell the services, they keep the money.
Amazon has to keep reinvesting just to stand still.
To maintain its position, yes. So selling 77% of Amazon could just be Berkshire saying, we don't want to fund this arms race.
That really fits their pattern. They don't like businesses that require endless capital.
It reinforces this narrative of de-risking from those high-cost, high-growth expectations. And the market notices that.
Oh, for sure.
When a holder like Berkshire slashes a position that drastically, it weighs on sentiment. It makes other investors wonder if they're missing something about the risk profile.
It wasn't just tech that got trimmed, though. We also saw reductions in financials, specifically Bank of America, BAC, and Aon, AON.
This acts as a real caution signal.
Bank of America has been a favorite for a long time. Why reduce now?
It could be a few things. It suggests maybe some wariness about the banking environment. You have to think about interest rates, what they do to loan books.
Or credit risk.
That's the other option. If they think the consumer or businesses will have trouble paying back loans, they'll want to reduce their exposure to lenders.
And Aon, that's professional services.
It's tied to business activity. If companies are hiring less or doing fewer deals, Aon's growth slows. Reducing these positions suggests a defensive posture.
So it sounds like they're raising cash and reducing exposure to things that depend on a booming economy.
That is a very fair assessment. And it can trigger copycat selling. When the smart money steps back from financials, it can create some short-term volatility.
And finally, we have to talk about the discretionary and cyclical trims. Smaller moves, but again, the signal seems clear. We're talking Pool Corporation, POL, and Constellation Brands, STZ.
This looks like a cleanup operation.
Let's start with Pool Corp. The name says it all. Swimming pool supplies.
It is the ultimate discretionary item. Nobody needs a swimming pool. You build one when you feel rich, when your home value is up.
And if Berkshire is selling.
It suggests they don't think the consumer is going to be in a pool building mood anytime soon. It's a move away from cyclical exposure.
What about Constellation Brands? They own Modelo, Corona.
That's a bit more nuanced, but it's still consumer discretionary. I mean, premium brands can suffer when wallets get tight.
So cutting these is another vote for safety over growth.
It is. It's a move away from the consumer who relies on credit or excess income. When a holder as big as Berkshire trims these kinds of stocks, it can impact liquidity at the margin.
They're tightening the hatches.
Exactly. The market sees that and thinks maybe the consumer is weak or cyclicals are risky, and it puts pressure on those stocks.
So let's try to pull this all together. What is the overarching theme of this filing?
The theme is quality over growth.
Can you elaborate on that?
Well, look at the buys. The New York Times, Chubb, Chevron. These are businesses with tangible assets, recurring revenue, strong pricing power. They're durable.
They can survive a downturn. And the sells.
Amazon, Bank of America, Pool Corp, those are businesses that either need a booming economy to thrive or require massive amounts of capital just to grow.
So it's a rotation.
It's a distinct rotation, moving toward durable subscriptions and value and away from mega-cap tech concentration and cyclical risks.
It sounds like a very defensive portfolio construction.
It is defensive, but it's also opportunistic. Buying the New York Times isn't just defensive, it's a recognition that the business model has fundamentally improved.
I see.
But yes, on balance, this portfolio is built to weather a storm, not to chase a bubble.
I want to wrap up with a thought on what happens next. You mentioned the market watches these moves closely.
I call these the second-order moves.
What do you mean by that?
The filing isn't just about what Berkshire did, it's about how the rest of the market will reallocate to mimic this perceived flight to safety. The market is a reactive machine.
So if Berkshire moves to safety, other funds feel they need to do the same.
Exactly. Managers look at this and ask, is my portfolio too exposed to Amazon? Do I own too much cyclical risk? And if enough of them say yes, you get a flow of funds that reinforces Berkshire's view.
So the trade isn't just buying what Berkshire bought, it's anticipating the market's reaction to Berkshire's reaction.
That's the game. You have to watch where the flows go next. Does capital start rotating out of big tech and into media or insurance? If it does, that trend can last for weeks or even months.
It is definitely something we will be keeping a very close eye on. It's rare to get such a clear signal from Omaha.
Clear as day. Quality counts. Cash flow matters. And maybe, just maybe, play a little more Wordle.
I can get behind that strategy. Now, before we sign off, I just need to read a quick disclaimer. Please note that this is not financial advice or buy or sell recommendations. This is purely the opinion of the author. Thanks for listening to Breaking News to Trading Moves. We will catch you on the next one.
See you next time.